Okay, let's take a look at the bigger picture. Ann McCabe is with us, CEO and partner at Curo Private Wealth. Thank you, Ann, for being here. What do you think we're seeing here in this market, which once again, it's basically up one day out of 6 trading days? I know this is traditionally a tough time. Your thoughts?
Yeah, great to see you, Nicole. Thanks for having me back. It's been just a brutal few days in the market, especially today. And we've seen the S&P sell off about, I guess with today's losses, roughly over 7% off the peak. We're still up roughly 12% on the S&P 500. And I think it's important to remember that since 1980, the average intra-year sell-off on the S&P has been about 14%. So we're nowhere near that amount, and I don't think we need to freak out yet. But what investors are concerned about, as has been widely talked about, is the Fed meeting last week and the increased and continued hawkish tone. And we gleaned some interesting insights from that meeting last week, namely that the Fed is expecting a soft landing. And, Chairman Powell was careful to come out in the press conference and say, no, that's not what we're saying. But if you look at the changes to the dot plot from June to September, that's exactly what it looks like they're saying anyway. They increased expectations for GDP growth, and they took away 2 rate cuts next year. So about half a percentage point of rate cuts next year, another half percentage point of rate cuts in 2025. And they're projecting for rates to be higher in the end of 2026 than where they see the long-term rate landing. So this hawkish tone has really spooked the stock market. We've seen yields on Treasury bonds just go up precipitously and incredibly quickly. We saw the 10-year Treasury yield hit the highest level we've seen since October of 2007, which is almost 16 years.
Right. So at this point now, if this is sort of your mentality on the market, a pullback could be a buying opportunity. And what would you say might be a good buy?
Yeah, we definitely do see it as a buying opportunity for long-term investors. We're also taking this opportunity to remind our clients that the future does not typically turn out exactly the way the Fed predicts. So case in point, if you go back to December of 2021, the Fed was expecting for the Fed funds rate to land at the end of 2022 between 75 basis points and 100 basis points. We now know what happened to interest rates in 2022, right? They went up a lot more. We ended the year at between 425 and 450 basis points. If you go back to December of 2020, that was still when we were deep in the trench of the COVID-induced recession. Most Fed officials were expecting rates would be close to 0 at the end of 2023. This was when they were saying inflation was transitory. So keep in mind, I know the Fed has a very tough job to do, but their track record is not great. So as investors, it's very important that we not make our decisions based solely on what the Fed is predicting and their crystal ball. For long-term investors, we really like to look at value and to look at some more quality names, because we do absolutely expect that the economy will at some point go into a recession. So we think good quality, good earnings, good profit is the way to look for adding positions to your portfolio moving forward.
Yeah. What do you think of Jamie Dimon, and not to put you right up against Jamie Dimon, but just more your thoughts on the big picture and how people are receiving a higher rate environment where, he said the world's not ready for 7% Fed rates. The VIX has spiked up to over a level of 18, and the markets have sold off, and there's just still now rate worry jitters. Your thoughts on the big picture on the world of rates and how high can they go, should go?
Yeah, I'm honored to be in the same sentence as Jamie Dimon, so thank you for the question. One of the things we're paying close attention to is the U.S. consumer, because the economy has been incredibly resilient so far this year. And one of the reasons is because we've had a very strong U.S. consumer, but we're seeing cracks in the consumer. And I agree with Jamie Dimon that we're not prepared and we can't sustain a 7% interest rate environment. We've seen savings come down for consumers. We've seen credit card usage increase. We've seen defaults increase on both credit cards as well as car loans, and student loan repayments are starting here in October. So we think all of this is going to get potentially even worse. Consumer confidence has came down about 8 points in August. We'll get another reading on that tomorrow, and we think it will decrease again. Then you pile on top of that the noise that we're dealing with the potential US government shutdown, which we think is likely. Gas prices are higher. So all of this to say that we think the US consumer is not going to save the economy the way that it has so far this year. And we're not prepared for a higher interest rate environment. It's definitely going to be tough.
Right, understood. Thank you so much. I mean, it really is great to see you. Any final thoughts here about any other investments or advice to investors today?
Yeah, I would just say I've reiterated this many times so far this year. If you are a long-term investor, try to keep your eye on the long-term prize. Try not to get too caught up in the short-term volatility and the jitters. If you have needs for your investments, they should be in cash in the short term anyway. So just try to keep a long-term view, try to keep your calm, and take advantage of volatility. That's the market on sale. So you would take advantage of any other market on sale, do so with great companies, with stocks as well.
All right. And McCabe, Curo Private Wealth, thank you.